This video will help you understand cost segregation so you can decide if it's right for your real estate. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. Before we get started with anything in this video related to things like cost segregation, bonus depreciation, accelerated depreciation, etc., please know that I am not a CPA. I'm not considered a tax expert according to FINRA and the SEC, and nor am I an enrolled agent. For your specific situation, obviously we'd recommend speaking with a tax professional that knows your unique situation. Everything we talk about today is going to be done at a high level and is not meant to be specific tax advice, and it's purely educational. And with all that out of the way, without getting into the pros and cons of real estate investing, the fact of the matter is, when you do have real estate as part of your overall portfolio, you are afforded some unique opportunities in the tax space. One of those unique opportunities is the ability to deduct depreciation as an expense for your business. According to the IRS, depreciation is defined as an annual income tax deduction that allows you to recover the cost or other basis of certain property over the time you've used the property. It's an allowance for the wear and tear, deterioration, or obsolescence of the property. Said another way, depreciation represents the hidden capital expense, representing a decrease in the viability of an income-producing property. Now, normally depreciation is taken over the lifetime of an asset, which for real estate could be up to 39 years, depending on the property type. But with a cost segregation study, you may be able to upfront deduct a huge portion of that depreciation in the first year of ownership. That's called bonus depreciation. Or with a cost segregation study, you might be able to at least accelerate the depreciation of this piece of property rather than sticking to the classic lifetime depreciation. Theoretically, this would allow you to save a bunch in taxes today, which just means more money in your pocket that you can go and invest in other endeavors that isn't giving it to the IRS. Essentially, you're taking greater deductions today and less deductions in the future so that you can have more money in your pocket today. So let's jump in. What is cost segregation? Technically, the strategy of cost segregation refers to two components. The first one is performing a cost segregation study or hiring a tax professional to do one. The second part of the cost segregation strategy involves taking those results from the first part and using those to accelerate the depreciation of a particular piece of property. Per IRS publication 946, which I'll link below, you can't accelerate the depreciation on your primary residence because it's not an income-producing property. So this strategy really only applies to residential rental real estate, flips, commercial real estate, things like that are meant to perform a bona fide business function. Now, there is a slight caveat to the primary residence rule, and that has to do with folks who use a portion of their home as part of the business that they own, whereby they'd be able to segment off a slice of their primary residence as an income-producing property, but that's incredibly complicated, and it would affect your ability to sell your primary residence in the future and maximize on the classic 250 grand per person capital gain exclusion. So it's generally not advised to pursue primary residence cost segregation because it's really expensive and the juice just generally isn't worth the squeeze. So what goes into a cost segregation study? If you have any familiarity with depreciation at all, you'll know that you cannot depreciate land, but you can depreciate everything on top of that land. And generally, people depreciate their buildings as assets over the lifetime of those buildings, which for residential and commercial are different timelines, but the IRS has a definition for their lifetime. On the contrary, per the IRS, a cost segregation study will break up your property into 4 parts, each of which can have their own timeline for depreciation. Those 4 components are going to be personal property, building components, land improvements, and then land. And as we discussed before, you can't depreciate land, but the other 3 are up for grabs. After your cost segregation study is complete, your tax professional will be able to help you identify which components of the 3 that are up for grabs for depreciation will qualify for either immediate depreciation via bonus depreciation, an accelerated depreciation over an accelerated timeline, or if any of those components will need to stick to the classic lifetime depreciation. Per the IRS, if you're classified as a real estate professional, which we'll get to that definition in a second, you're able to use these depreciation expenses to directly offset active income, dollar for dollar. To meet the IRS's definition of a real estate professional, you or your spouse would essentially have to have real estate be their full-time job. So they could work in a capacity like a real estate broker or a full-time property manager. Specifically, the definition of full-time would be 750 hours a year, which is right around 15 hours a week in real estate. If the IRS does not classify you as a real estate professional, aka you don't meet those aforementioned criteria, then any losses you're deducting as depreciation would be considered passive activity losses and can only be used to offset passive activity gains. Think the capital gains inside your brokerage account, or if you sell like a primary residence and it has capital gains attached to that, you can only use passive losses to offset passive gains. There is one slight caveat to this rule whereby if you have excess passive losses over and above whatever passive gains you have, you're allowed to, as a household, use $3,000 of those passive losses to offset active income or earned income up to $3,000 per year. And the rest of that harvested passive activity loss, you can harvest against future gains indefinitely in the future. So for example, this was the case at the end of 2022, whereby we did a bunch of tax loss harvesting for clients inside their non-retirement investment accounts. This led to them recognizing an excess passive activity loss amount inside their portfolio, whereby their losses far and exceeded their capital gains. And that ultimately led to them being able to use up to $3,000 of those losses against their ordinary income, and or just harvest the rest of those losses against future capital gains, which they most likely will have. Keep in mind though, doing a cost segregation study is not without its own costs, both monetarily, but then also from a time perspective for all of the parties involved. We won't get into those specific costs here. However, know that there of course are hourly rates that start to rack up when you hire professionals to do this kind of stuff. In addition, the time you'll spend monitoring this process will take away from your primary business function. And so you're probably going to want to make sure that this is a good fit before spending all the energy to get this ball moving. But let's fast forward and say you've decided you're going to pursue getting a cost segregation study done so that you can accelerate the depreciation on your property. The number one recommendation when it comes to that is to not try to do it yourself. There are competent, specialized professionals that work in this space that we'd recommend you hire and work with, because odds are if this strategy is going to make sense for you and your income tax bracket, it's probably not in your hourly rate best interest to try to learn how to do this process yourself. It makes way more sense just to delegate to somebody who theoretically has a lower hourly rate than you. There's a ton of moving pieces, and I would just absolutely hate it if one of my clients decided to try to spearhead this process, thought they were well and clear, and then in a year from now, they get a nasty gram from our old Aunt Iris, and now they have to free up a bunch of liquidity in maybe some other investments that were illiquid, and it kind of puts them in a bind because now they owe more in taxes than they thought they did. It's just not worth trying to do it all yourself. On the flip side, let's say you've decided that it's not worth pursuing any of this depreciation strategization and you're just not going to take depreciation at all. Well, that's absolutely unadvised, because depreciation recapture taxes, aka the taxes you'll pay when you sell the property based on the depreciation you took before, whether you bonus depreciate, accelerate depreciation, or just take regular linear depreciation throughout the lifetime of the property, when you go to sell that property, you'll owe those depreciation recapture taxes. And if you chose to never take the tax deductions for regular depreciation, you'll still owe depreciation recapture taxes on the phantom depreciation that you should have been taking. So there's really not ever a good time to not take depreciation in one form or another on these income producing assets. Talk to your tax professional, of course, for the best course of action, but oddly enough, the IRS still requires depreciation recapture taxation, whether or not you actually took depreciation. Okay, so hopefully that was helpful in sharing a little bit about how cost segregation works. If you have more questions, drop me in the chat below, send me an email, we'll get you squared away. Have an awesome rest of the week. We'll chat with you later. Bye.